Hello, welcome to our stock trades. I have a lecture set up with you guys with a PowerPoint presentation. We are going to be talking about the psychology of the financial markets. So the problem that we have here is that a lot of retail investors are not educated within the historic avenues of economics. And a lot of the hedge funds, financial market makers, financial analysts, they all go through a set of education, study specific entities that have won Nobel Prizes in terms of the psychology of economics or behavioral economics. And it gets to a point where a lot of retail investors don't know and understand fundamental analysis, but they also don't understand sentimental analysis. So in this video, I'm going to do a service to the public. I'm going to be educating you on things that you may want to keep under your belt, kind of the back of your mind, to help you be successful within the stock market. Because it's not all about just finding a successful company, finding a moat. It's about mentally preparing yourself for the stock to go down 90%, even though nothing's changed in the business. And in order to get to that level, you need to have some understanding of psychology, okay? So this is exactly what we're going to be talking about. So to the man to the left here is Adam Smith, and then you have two really amazing psychologists that I really like their study. We're going to dive more into them in our mastering course, but I wanted to give you guys some equations that may help the public and my subscribers. So without further ado, let's talk about the principle of rationality, okay? So a lot of economists believe that in order for an economy to function well, the entities and agents within the economy have to act in a rational way. Well, if you ask any typical person, they're going to tell you that that does not exist. People are emotional. People do not act in rational ways. They act in irrational ways. In essence, people behave stupidly. But the problem with this is that history is essentially if you look at history, it is the study of humankind exploiting other people's weaknesses, other people's stupidity. Okay? And we can give multiple examples to this. And some current examples are, a lot of people, for example, coming in for a special cause, wanting to, let's say, hold something and buy a particular stock and get to a level where stocks only go up. So what ends up happening is you have individuals coming in, purchasing a stock that has essentially risen 70, 80%, thinking that it is going to go higher. Then, at the sign of just quick loss, it destroys people's theses and then they walk out. So what market makers do and what hedge funds like to play is they like to send a stock up going high, okay? It brings in people and then they drop it and they make money obviously by buying low and selling high and also by shorting the stock when it's at high levels. And there are a lot of algorithmic entities or psychological indicators and all these things that you can use to help essentially exploit the money of retail investors. So we can't talk about behavioral economics or behavioral finance or essentially the psychology of the financial markets without mentioning Adam Smith. So he essentially is the father of economics. And people coin him to be the father of capitalism. So back in 1776, well, he wrote two books. You may not know the first one, which we'll go over, but the second one he wrote, The Wealth of Nations, in 1776, which is, I believe, when the United States became a country. This was the first real book of economics. In this discussion, we're going to focus on the book he wrote in 1759. What is that, 250 years? And it's still a good read, right? The Theory of Moral Sentiments, okay? So he had a question. Are people completely selfish? And we're gearing this towards, how people transact, how businesses behave. And what he concluded was actually not that. He found that humans desire praise, right? So let's give you an example. So you know how like AMC, GME, it became a community. It became a community of praise. And it's gotten to a point. In fact, I had just literally someone just comment on my AMC video. And they literally said, believe this or not, they said that they are going to hold this stock until it goes to zero. And they don't care. Now, let's go back to our central discussion here. People behave stupidly. And the principles of rationality is not quite conducive to what humans act like. Humans are irrational creatures. They are emotional creatures. And what people can do is they can exploit this stupidity. And it's very sad, but in the stock market, there's always a buyer and seller. And by you understanding this, you are going to have a superpower in knowing how people act, which is a $1 trillion business, right? And you'll be able to exploit people in the markets. And what we're going to be doing in the mastering course is we're going to be learning about the psychology of how essentially stocks go up high, knowing when to short them, knowing when to attack them, and knowing when to get into them using technical analysis, fundamental analysis, and sentimental analysis, and multiple analytical tools that extend back to famous psychologists that and capitalist theorists that essentially, these two, I believe they won the Nobel Prize. So people desire praise. They want a self of belongingness, okay? And you can exploit that because, I remember there was a cult stock, SPRT, it was a short squeeze indicator. We had it ran really well. And then once it started showing signs of hiccups, I said, hey, let's get out of there. I saw a lot of people on the Webull chat, screw you, get out of here. And where are they now? They've been destroyed. But did they learn their lesson? No, they did not. Okay, so now we're going to shift gears into prospect theory, which is the birth, I want to say, or the continuation of behavioral economics. So we're going to talk about two important people, Daniel Kahneman and Tversky. These are very important studies, and if you don't understand these, then you're really, really hurting yourself when it comes to the stock market. So they wanted to ask, this question: how people form decisions under uncertainty, which is all about the market. It's uncertainty, right? So they created two equations. The value function, which wants to basically say, ask how people value things. And then they also created a weighting function. And they wanted to ask how people deal with probabilities. Okay? So this is the value function. And I'm going to walk you through this graph. So if people have math amnesia or something, we're going to walk through them. This is the x-axis. And this is the y-axis. If you go this way, you make money. These are gains. If you go this way, you lose money, okay? Obviously, if you're going up like this, when you gain money, you have a positive value. You are happy. If you go down and you lose money, you have negative values. You're sad. So what can we take away from this graph? Well, let's focus on this quadrant here. Whenever you make money in the markets or whenever you have a gain, it's a slow and gradual rise, but there is essentially a rate of limiting returns, or essentially you get to a point where these small gains are less encouraged. You get to a point where it's like it plateaus. There isn't any more positive value when you gain so much. That's why people always say money doesn't buy you happiness. Well, in the beginning, yes, but once you get to a position here, there's not really much value. But on the contrary, if you take the gain of, let's say, you move an inch, look at how far you are in terms of value. But if you move an inch here, look at how low you are. Look at how low you are. So I personally, the way I would draw this graph, and I actually studied Tversky and Kahneman extremely well, I would draw this in a very lower negative slope. I drew this one, right? But I would draw this down. So essentially what we're trying to say here is that people will have more negative values for a loss than they have gains. People get so upset. Like right now, imagine if you go to the market and you lose $5, $10. You go to like the mall and you drop $20 and you lose it. How sad and pissed off will you be? But in reality, in the greater scheme of things, it's just $5, $10. It doesn't mean anything. If you compare it to the present value of what you're going to be essentially gaining in the future, which is in the millions of dollars of what you're actually worth, your terminal value. I'm using these key words, terminal value, for the Mastering Stock Market course. Remember, intrinsic value calculation is a terminal value calculation. It's all math here, okay? But there's like a kink here, and it's called the reference point, the state of well-being based on where you are at in society. And what that means is that people are so conscious over how much money they will lose more than they will gain. And businesses like to exploit this behavior by offering funeral insurance or airline insurance, right? People exploit this. And we can find multiple things in the stock market where people exploit. And we will be giving you these examples in the Mastering Stock Market course, and we will go in depth in how essentially learning these things and learning these examples, how they will make you a better trader, a better long-term investor, a better entrepreneur, and just have a strong mentality not to follow the crowd and lose money. You know, they say 90% or whatever of traders lose money. Well, because they follow. You can't be a follower in the stock market. You will lose. And there is a lot of psychology, a lot of math, and we're going to dumb it down and distill it to its most concentrated vial and give it to you for the most ultimate success. So now let's talk about probability fog. You see, most humans cannot psychologically accept probabilities between 0 and 100. When the probability is low, most people round down to 0. Likewise, when the probability is high, most people round up to 1. We'll explain what this means. Okay, I'm just giving you an introduction here. There are some people that blow it out of proportion and over-exaggerate. Okay, and this is a big one here. When it comes to short squeezes, cold stocks, you name it, okay? So what is the probability, I'm going to ask you, of dying from a plane crash? And the answer is here, 1 in 11 million. But if you were to ask people, this is the weighting function from Daniel Kahneman and Tversky. And what they found is a lot of people say, 1 in 1 million, it's low. It's 0. Round down to 0, it's too low. Some people might say, well, I'm scared. It's and they just bump it up here, okay? And then other people, let's say if we find a high probability, for example, if you smoke X, Y, and Z, it's high. It's probability is 1. It's cancer. Boom, okay? Even though it's pretty high probability, right? But what does this tell you? What are these open circles and all these things? What that tells you is people do not know how to value a probability. If it's close to 0, if it's low, they just round down. If it's near here, they round up. But they don't understand the middle. They're like, maybe. So you can basically parcelate the probabilities of 3 itemizations of an outcome. Essentially, it can happen, maybe, and it will. And what you can do here, sadly, I use this word, but that's what education is. That's what stock market is. It is competition. you can exploit people's behavior by understanding how they value a probability of, let's say, a short squeeze. You can exploit their behavior of negative value when a stock, let's say, short squeezes up to 70, but then it drops down to, let's say, 60 or 50. If they are combining together, and through Adam Smith's book from 1759, you can basically, this is some old stuff here, right? You can basically say, well, they have a cult, which means they're not thinking clearly. They are not thinking clearly, and they will essentially hold the stock to zero, meaning that they're going to essentially lose a crap ton of money. When shit hits the fan, when I started shorting the stock, they're going to all run out the door, and they're going to have a herd mentality, which is another equation, and they're going to flow out. Likewise, you can use other indicators, technical analysis, fundamentals, when, let's say, the stock is low. It's trading sideways. Like, for example, Clover Health. No one's talking about Clover Health anymore. It's dead. You know what I mean? And you can use that and get into it. And then later, when the stock goes up X amount of percentage points, 100, 200, 300%, 1,000%, people are going to start flooding in. And you can exploit this behavior because the probability, all of a sudden people are going to say, the probability of a short squeeze is high, and they're going to put it to 1. And you can use this graph here and say the probability of a short squeeze going close to 1. You can use this graph to exploit people's behavior and make money in the market. And that's how hedge funds act. And once you pump them up to that level, then you can short the hell out of the stock. But how do you do that? You have to understand fundamental investing. You have to understand what the hell is calculating the intrinsic value of a stock mean. And once a stock goes up to that area, you can graph its historical price trends between the bear, base, and bull. And then you can do a standard deviation analysis, which we will teach you. And then you can look at the price extremes, aka you can plant a Fibonacci sequence on top of the price, and there you go. So there's a lot that we're going to be talking about, a lot to learn. And sadly, it is unfortunate that it's like this, but it is a history of, the history of humankind is a history of exploitation. The history of humankind is a history of exploitation. And people don't act in a rational manner. They're irrational, which means you have an edge. So don't forget, there's a link down below to enter our competition. Go ahead and sign up for Mumu. Deposit at least $100. Go in, comment your name down below, and you will be in our raffle to get a whole year subscription of Al Stock Alerts. I will see you on the next one.